Hello and welcome to today's lesson. I'm your hard-working but indefatigable teacher, Mr. Burton. You will need to watch this video and take notes as you go. You may need to watch certain parts of the video a few times to ensure complete understanding. This is your homework and I will check your notes tomorrow before we get started. I hope you learned something.
Hello and welcome to today's lesson. Today we are looking at the second method of depreciating, the diminishing value depreciation method. Right, so very similar to our first lesson. What we want to do today is be able to calculate the depreciation, just this time using a different method, the diminishing value method. Prepare a depreciation schedule, the journal entries, and then extracts for the income statement and the balance sheet. The only thing different is how we depreciate. So, not straight line anymore, we are diminishing value depreciation. Now, the diminishing value depreciation reduces the book value of the asset at a higher rate in the earlier years that it's owned, and at a lesser rate in the later years. Now this method is best used when the most of the expected benefit from the asset is going to be greater at the start of its useful life and then will decrease over its useful life. This is because diminishing value depreciation calculates the most depreciation in the first year or two, and then the amount decreases after that. So as opposed to straight line depreciation where the value of the asset was depreciated at the same amount each year, diminishing value is proportionally more in those earlier years, and then the depreciation amount becomes less and less in the later years of the life of the asset. We have a formula. This is a carrying amount times a percentage. So for example, we've got a car purchased for $20,000 excluding GST and has a balance in its accumulated depreciation account of $5,000. Depreciation is calculated at 20% diminishing value, 20% DV. How much is the depreciation expense for the first year? Carrying amount, $15,000, easy to calculate. And then 15,000 times 20%. And if your maths is okay, that works out to be $3,000 in the first year. And it won't be the same year after year after year as straight line was. A delivery van costs $35,000. It's expected to last 8 years. Residual value of $3,000 at the end of its useful life. Depreciation is calculated at 20% DV. What's the amount of depreciation for each year? Remember, we need to calculate the carrying amount first here. No accumulated depreciation in the first year. Carrying amount $35,000. $35,000. What's 20% of $35,000? In the first year, $7,000. That's the amount to be depreciated. That's a value that's coming off our van. Right, next step, filling in the depreciation schedule. Exactly the same as we've been through before. Year cost, carrying amount, opening, depreciation expense, accumulated depreciation, leaving us with the carrying amount closing. A van costs $35,000. That's our opening, carrying amount. Depreciation expense of $7,000. That's it because it's our first year. $35,000 minus $7,000 will give us our carrying amount closing. As we know, that carrying amount closing will become the value of our carrying amount opening in the second year. Now our depreciation expense changes. Carrying amount opening, $28,000. 20% of that is $5,600. Leaving us with a carrying amount closing of $22,400. becoming a carrying amount opening 22,400, 20% of that is 4,480. Accumulated depreciation, that's added on, giving us a carrying amount closing, and the process repeats. Now we can see that the first year the depreciation expense is the greatest, and diminishing value, that depreciation expense decreases over time. Depreciation expense greatest in the first years and subsequently becomes less and less and less. The General Journal, recording that, it's exactly the same as we've been through before. Depreciation on the van and accumulated depreciation on the van are the debit and credit associated with that, and the narration depreciation on the asset, on the van, $7,000. Income statement, again, we've been here, done that before. We're talking distribution costs here, depreciation on the delivery van of $7,000 on our income statement. That's an expense. Our balance sheet, again, we're preparing that note for property, plant and equipment. It's done in exactly the same way. Delivery van, opening carry amount, depreciation, closing carrying amount, and because it's the first year, that's simply repeated down below. Our first note for property, plant and equipment in year one for that van. Next we're going to the balance sheet, we're filling in that carrying amount. Non-current assets, our van is now worth $28,000 after the depreciation. We're going to move on to year two. You can try this for yourself, pause the video. It's exactly the same apart from the depreciation as the straight line method, apart from the depreciation amount has changed. So the top half and the bottom half are going to be different after that first year. The depreciation expense, nothing different here. Depreciation on van, the new amount, accumulated depreciation van is a credit. Year two, the van depreciation is $5,600, our general journal entry. Okay, onto the income statement. Same thing, different amount. Depreciation on delivery van, this time $5,600. Our balance sheet, our statement of financial position, our note for PPE. Right, the opening carrying amount is that initial amount after year one. The new depreciation, $5,600, will give us a closing carrying amount of $22,400. Now remember, the van cost us $35,000. Our accumulated depreciation is after year one plus year two is now $12,600, which will give us a carrying amount of $22,400 after that has been subtracted away from $35,000. And now we're going to go to the balance sheet, and it's dead easy now. Non-current assets, PPE, our note, our non-current assets are property, plant and equipment valued at $22,400.